Welcome to another episode of What's on Your Mind, a new weekly series brought to you by the Institute of Trading and Portfolio Management, where we'll be talking to the Institute's senior trading mentors about what's been on their mind in the financial markets over the last week. My name's Chris Quill, and today I'm joined by David Perlin and Hichem Djouhri. Now, due to restrictions in Dubai on Skype software and other voice over IP services, Hichem's actually going to be dialing in via phone for this call, and unfortunately that means there'll be no video feed available from his side of the call. Now, just before we jump into the show, I want to remind you guys watching that if you want to learn more about trading and investing or what the Institute does in general, then please head over to our website, itpm.com, and from there you'll see a bunch of different resources and links to things such as our live upcoming seminars, our online education courses, our bite-sized videos, and also the mentoring programs that we do around the world. So with that being said, let's jump straight back into the show. And David, I think we'll start with you this week. What's been on your mind?
Good morning, gentlemen. Well, I guess on my mind, since I live and work in Washington, D.C., politics, tariffs, and connecting with Hichem on the ramifications to EM, which have been kind of front and center to global macro especially, and we'll tie that together for everybody today. Obviously, respecting the recent rally after several quarters of excellent profit growth, all the U.S. indices maintain enough velocity over the last few weeks, August in general, to make new highs. First new highs across all indices since late January. Remember, please recall the February correction. So it took a lot of wonderful reporting from corporate America with the help of tax breaks, economic growth, consumer confidence, etc., deregulatory administration policies as well. To get here, we should respect it, but I continue to look to roll inexpensive puts on exposure because vol has been suppressed. What I would like to take an opportunity to speak about today, given this is what's on your mind, is the geopolitical backdrop and an outlook that is now approaching that could have ramifications for risk and investing. And that is specifically the U.S. non-presidential midterm elections, which are literally fully taking flight after the U.S. Labor Day holiday this weekend. So every 2 years, Congress, the entire House of Representatives runs for office. Quite a blood sport. And historically, the party in power, specifically in the White House, typically loses control of the House. It happens a lot, and the odds are, based on everything you see and read, that will happen again. This probably does not occur in the Senate, where the Republicans will maintain a slight majority. And for our world viewers, a majority alone in the Senate is not sufficient to get legislation passed. You have to have 60 out of 100 votes, except for Supreme Court justices. Don't want to get too much in the weeds, but there won't be much going on in the Senate in the next 2 to 6 years, depending on whether Trump seeks and wins a re-election. So what does a House flip mean to the markets and to progress? I think, to put a fine point on it, don't expect any major legislative victories by the administration. You won't get anything approaching the massive tax package that passed because the Democrats will inflict some sort of gridlock on the Republican agenda. And on the risk side, because we're not really banking on major legislative packages anyway, but the risk is that the Mueller investigation, as distracting as it has been, will pale in comparison to the onslaught of congressional investigations that will follow if, in fact, the Democrats win a majority of the House votes or seats. So just to put an example together, there were 52 subpoenas sought by Democratic leaders in the past 2 years on Trump and his administration. All of those were blocked by Republicans, given their majority. So you can envision dozens of investigations getting approved and people getting subpoenaed to advance investigations in all manners of Trump and Trump Inc., including tax returns. This will be a giant distraction, and will make the tweet storms rise to new levels. So that's going to be probably not great for equities, and I just want people to be mindful of that. The other thing I want to talk about, since we are talking about investigations, is that the market has started to factor in a higher probability of impeachment. That, I think, my friends, is a bridge too far. I will not bank on that happening. If it starts to get some momentum in the investing space, and our president himself has declared that that would be a disaster for asset prices and world economic growth, I would take the other side of that bet. I think that, A, you fade any risks of impeachment, of it happening. B, if it in fact happens, and no doubt there would be a fairly massive reaction, probably downward. But Pence and the Republican leadership will be consistent in the policies that have been equity friendly thus far in the U.S. I would like to bring in my colleague, my EM expert, because clearly what has been U.S. strength and U.S. Or Trump use of tariffs and trade policy in a political sense has had a massive impact negatively on emerging markets. So Hichem, take it away.
Absolutely. Thank you, David. I just want to start off by talking a little bit about currencies within the EM space. Generally with currencies, it's the quickest way to restore competitiveness of a country's exports when faced with the penalty of tariffs. So we're likely to see further currency devaluations in EM markets. Of course, when currencies collapse too severely for reasons other than tariffs, this usually signals a crisis within the country, and it leads to a surge in inflation, as we saw in Turkey recently. In July, inflation was up about 16%, and this makes the foreign debt about 30% of GDP a lot harder to repay. The consequence of that is an intervention to restore confidence by central banks, which raise interest rates significantly. In Turkey, they raised it to about 17% in July. And we expect further rate hikes as the Turkish lira depreciate against the dollar by about 70% within that month and 30% year to date. Moving away from Turkey and looking at EM markets, we tend to look at trade-weighted USD, and that has appreciated about 6% since the beginning of the year. And most of that strength took place starting in April. And the US dollar has been acting as a safe haven currency for quite some time. If we look at the Mexican peso as another example, similar to other Latin American currencies, they used to track the yuan because China is an important trading partner to these countries. However, the peso weakened about 70% between 2014 and January 2017, and this was during Trump's anti-Mexico campaign and his coming to power. Since then, however, uncertainty as to the severity of the impact on the Mexican exports and the general economy of Trump's intention to revisit the NAFTA agreement has caused major gyrations in the Mexican peso. That being said, Mexico has been the best performing EM currency this year, up about 6.5% to the dollar and 10% to the euro, and that's partly due to Trump softening the terms of the NAFTA, combined with the recently elected President Obrador, who's actually pro-market. So there are a lot of trades to look at here in the EM space, either on buying dips or from a valuation perspective. We were talking about a 25 to 30% discount to developing markets. So there's plenty of scope for revaluation of EM relative to DM market. So a balanced portfolio can't take positions on EM, but on a selective basis. To our listeners, and those who are able to watch the video, there are some trades that can be put on here. However, having the right hedge in place is extremely important. If you're long the equity, then you need to be hedged on the currency, because movements in opposite directions, you may come out without any performance there. Another point that I'd like to touch on is the outflow from emerging markets. So overall, within the EM space, it has been relatively modest year to date. But when we look at the MENA region, the flows, particularly on the DFM stock exchange, which is the Dubai financial market, has been about $250 million year to date, which is not a huge number on its own, but relative to the size of the market and sort of the daily volumes that it trades, which is about $30 million. Those come out to be quite significant. The market in Dubai is down about 16% year to date. There is a definite slowdown on the ground, and the correlation to oil. And whenever we speak MENA, we speak oil. The correlation to oil has been mainly to the downside, and no participation to the upside. Volumes again are extremely low. It's a retail-driven market, so the institutional money that comes in is very much a buy and hold on a selective basis. Now, when you compare this to the Saudi market, which is up 10% year to date, the first question is why are they moving in separate directions? The reason for that, again, is related to the flow into EM. So Saudi market was recently included to the MSCI Emerging Market Index. We included to be in November of this year with a 2.6 weight, which is a decent allocation. Now, usually whenever you get an inclusion into a market, there's a rally ahead of the announcement in anticipation of a positive one, and on confirmation as well up to actual inclusion. Now, the flow that will move into the market will move selectively, other than the ETF flow. But when we talk about active money, it will be done on a selective basis. The market currently is not trading at cheap levels. And when we look at the earnings season this year in Saudi Arabia, the main sectors that have benefited have been banks and petrochemical banks, purely due to the dollar peg, wherever there's a rate hike in the U.S., they follow the same path, and the banks have benefited. The petrochemical sector has also done well, with earnings up about 100% year on year and about 30% over the last quarter. Banks have done a little bit less than that. They're up about 15% year on year. This is compared to the rest of the market, which has done quite terribly. If you look at building materials, and they're down about 100%. Healthcare has also taken a huge hit, down about 25% year on year. And this is due to several changes that have happened on the ground. A lot of austerity measures that were taken post the drop in oil prices led to several government contracts being paused. Cash flow became an issue where companies within these sectors weren't able to finance their working capital, and consumer spending took a large hit as well. So we are seeing ramifications that still haven't bottomed out from these austerity measures. Now, with oil prices having picked up slightly from the lows that we saw a couple of years ago, there's been a return to spending from the governments, but that's going to take quite some time to go back to levels where we were pre-2014. Going back to the UAE market, there's been quite a bit of weakness in the property market, and as you had mentioned, with interest rates going up due to the dollar peg, mortgages are going to start becoming a bit more expensive. With an existing oversupply in that market, there are fears that the market will take quite some time to recover, if not take a further hit from where we are today. So to our listeners and viewers, what would one do here? There are several trades that can be put on. The easy option would be to look at puts on the DFM stock exchange altogether. However, what I would do is look at specific companies within the real estate market, because they're not all created equal. Some are somehow better projects that are in their pipeline, much stronger cash balances on cash positions on their balance sheets, and other companies are, on the other hand, are struggling quite a bit. So selection is quite important versus just allocating to a sector from where we are right now. So definitely we're in a stage where there are dangers that are looming from oil prices, from the dollar peg that is quite expensive to maintain, from interest rates that are causing credit growth to slow down in the market. So these are things that need to be looked at closely. Furthermore, the credit default swaps of the buying, so on the 5-year, they've gone up about 30% since March. These are all indicators that there are definite fears in the market. However, another thing to keep in mind is that the market is down 16% year to date. So to talk about a further leg down in a market that does not trade quite heavily, and the index is composed of mainly banks, real estate, and telco names. They make up sort of the lion's share of the index. So any movement in those three sectors, you'll see the index move quite aggressively in either direction. So the play here is not so much on the index again to rate, but rather on specific names.
Hichem, since we're here and speaking EM, we actually are living through a live example, a very visceral example if you're an Argentine or Argentinian if you prefer, and their currency is absolutely collapsing as we speak. And just a few weeks ago, the U.S. market and developed world had a bit of a hiccup as the Turkish lira started to collapse. So I was wondering if you can just talk more broadly about risk off in these currency situations. What do they typically look like, act like? Should people be prepared for more of a overarching drawdown as a result of contagion fears?
Absolutely. I mean, if we look at the moment, Trump is mainly focusing his trade aggression on China more so than others. Europe, his NAFTA partners, Japan and Korea, though those the turn will probably get there as well. And global trade wars and competitive currency devaluation could be a crisis similar to 2008, not to scare any of our listeners. But at such times, forward valuations that assume visibility of earning forecasts become quite unreliable, similar to technical indicators as well. So trade wars bringing dollar strength as the U.S. is seen to benefit near term at the expense of the countries with which they're aiming to reverse its trade deficits. So these trade rivals are experiencing large capital outflows. So the countries with a lot of dollar debt should be supporting their home country so that their debt doesn't balloon in local currency terms, as I had mentioned earlier with the Turkish examples. And the countries without excessive dollar debt, but that are suffering in demand for their exports because of Trump's tariffs, will be tempted to let their currencies devalue to maintain the competitiveness of their exports. Turkish lira is the worst currency year to date because of a combination of high U.S. debt and the U.S. threat of sanctions. The trade war initiated by Trump is an enormous threat to world trade, in which EM countries depend for growth. So trade war could reduce global growth, now running at about just shy of 4% by at least about 50 basis points per annum over the long term. So for our listeners, it's important to look at the debt of these different emerging markets and in which currency that debt is held in order to assess where that currency is going to flow.
Yeah, for our viewers and listeners, I would urge you to take a peek at session 1 or 2. Chris, you can specify, which was Chris Cathy and Ross Williams speaking about what was on their mind. And I think there were some exceedingly valuable lessons about where we are in a market cycle, and things to be wary of. I do believe what Hichem is speaking about and contagion fears will be kind of an ongoing break on how quickly we get more upside velocity in this market. There are plenty of things to pay attention to. I think my overarching lesson from all of this is macros matter, and sometimes the U.S. market doesn't pay attention to it, not every day, but they will, and that's why I continue to roll puts as a hedge in my portfolios. The other thing I found really interesting from Ross Williams in particular was some of these relative value plays, even in semi-developed relative value plays, where there's a 50% divergence in Chinese internet stocks from U.S. internet stocks, and just today in the headlines, Tencent, which is one of the leading Chinese internet gaming companies, is under pressure again as the health authorities say that Tencent's gaming enterprises are causing young people to have vision issues. So these are the kind of things that I love to look at as a mean reversion trade, where ultimately Chinese internet has probably the most robust outlook in growth in the world, and probably at a 50% discount to its U.S. peers is worthy of taking a look on the long side. Buy dips in general, especially if we see impeachment, especially if we start to get hysterical about emerging market currencies. Although, obviously carrying a hedge into those reactions is a valuable way to maintain and protect your capital.
Yeah, so that was linking back to Ross Williams in episode 2, and I think it's an interesting point that's come up in probably all 3 of the episodes that we've done so far, is that kind of extreme times or large movements in certain asset prices can present dislocations in other markets that aren't maybe strictly correlated historically. So there are potentially things to take advantage of. I think that's what Ross was saying last week, and you were also referring to a little bit here, David.
Absolutely. I thought that was really timely and topical.
So Hichem, do you have any more to touch on the MENA region, maybe with a particular focus on what retail traders can implement?
Absolutely. I mean, we spoke a little bit about the macro in different sectors to look at. There are different ways that the market can be played, either via baskets on specific names, especially the higher beta names for those that want to take a directional bet, or taking positions on puts, be it on the Dow, which is a Saudi stock exchange, or on the DFM stock exchange. There is an iShares ETF that can be traded. Furthermore, the correlation with the oil is higher with Saudi Arabia than it is with the Dubai stock exchange. So taking a position on oil is not necessarily taking a position on the Dubai stock exchange when we're talking about any potential upside in oil. However, if one does have a bearish stance on oil prices, then the correlation becomes much higher on the downside. There is the 5-year CDS that can be played as well as a potential trade. So synthetic options on those are available, and direct exposure to the underlying names on these 2 stock exchanges in particular within the real estate sector. There could be potential shorts to be exposed or to extrapolate the case from. Those would be the main ways to play the market at this point in time.
Excellent. Do you have anything to add, David, as far as I think you were talking about your longer term view, or thinking about a longer term view of the US previously?
Yeah, I do think that, just put on kind of the long term radar, the fiscal glide path in the U.S. is unsustainable. And what I mean by that is our deficits are going to explode. The results of this current tax break, especially on the corporation side, has been exceedingly pro-equity, but the U.S. balance sheet is in distress, and neither political party has the will or ability to address the long-term structural issue, which is entitlements. That's Medicare and Social Security. So the CBO recently released an outlook for long-term budget deficits, and at this current path, we will double our deficits in 10 years. And ultimately, the U.S. hegemony trade, the U.S. first, the U.S. as the place to invest, at some point starts to come apart a bit as we become, on a sovereign basis, not in great shape on the fiscal basis. So the dollar gets less attractive. The safety of the institution becomes less attractive. So that's something that has to be addressed over time. It's not today's trade, but you'll continue to see headlines indicating that this is something that needs to be addressed.
Just another idea on the MENA region, especially with the strengthening dollar, is to look at and a weakening tourism sector here. There's a slowdown that started in 2017 and hasn't really reversed just yet. You can play the aviation sector on the Dubai exchange versus on one particular name. The other way would be to look at the bond market and to look at the large airlines that have issued corporate bonds. That could be another way to gain exposure to the region. And with interest rates rising, there could be a potential trade there to benefit from.
Okay, great. Unfortunately, I think that's all we have time for this week. I hope you guys enjoyed the show, and thank you very much, David and Hichem, for sharing your thoughts with us on this week's episode of What's on Your Mind. Now, just as a quick reminder to you guys watching, if you want to learn more about trading and investing or just what the Institute does in general, then head over to our website, itpm.com, and then from there you'll see links to a bunch of different resources, such as our live seminars that are upcoming, our online video education, our bite-sized videos, and our mentoring programs that we do around the world. And those mentoring programs are with guys like David and Hichem who can really take your trading to the next level. So that's all from us. I hope you guys enjoyed the show, and make sure you join us next time for another episode of What's on Your Mind.